Thank you. My name is Jason Wassell. I'm Chief Executive of the Consumer Credit Trade Association. For those that don't know me, we are a trade association that's involved in alternative lending, have been for a considerable number of years, I think over 130 years. And in more recent times, we've been heavily involved in the conversation around affordability, particularly because at points we have represented many of the high-cost lenders as well as part of that kind of alternative lending market. I'm delighted to be here today and to get involved in this conversation. That's my introduction, really. That's all I'm going to say to introduce the panel. I'm going to let the panelists themselves introduce themselves and talk very briefly about their organization and also their connection to affordability. So if I could start, I'm going to start at the far end of Andrea. Could you start us off?
Hi, so I'm Andrea Cox. I'm Affordability Director at Equifax. Equifax, as you all probably know, is a global data, analytic and technology company. Our role in affordability is to understand the market, what's going on, what our clients need, the regulatory framework, etc., and ensure that we use our data, platforms and analytics to ensure that consumers get a good affordability outcome.
Thank you, Simon.
Good afternoon. My name's Simon Dukes. I'm Chief Exec at Fair For You. We're a charity-owned lender. We specialise in very small loans between £25 and £500. We don't lend cash. We lend on a prepaid shopping card, or we lend for a specific item. But we're very much focused on providing small loans for essential household items. We've been in existence since 2015, and this week we will be doing our 100,000th loan. So we're very pleased about that.
That's great.
Hi, I'm Rob. I'm one of the co-founders of Plend. So Plend, slightly opposite from Simon, we do larger loans, consumer loans, focusing on funding outcomes. So home renovations, debt consolidation, paying for holidays and other kind of medical, legal costs, big things for your life. We use open banking data to do affordability, so this is quite an important topic for us, and the challenges that come with using that data set. And I don't think there's anything else I'm going to say. That's it. Yeah, I've gone 4 years. I'm very excited to be here. Thank you.
Thank you.
Hi, my name is Neil Kadagatur, and I'm the CEO and founder of Credit Spring. We would like to say that we are the leaders in a brand new lending category, which we're calling subscription finance. Subscription finance, what is it? It's simply small, short-term loans that have no interest. They come with a fixed membership fee. This helps people manage themselves through small, short-term opportunities, short-term emergencies, etc. Life to date, we've lent over £315 million, and we have almost 1 million members in our community today.
Thank you for that. Andrea, I'm sure you have a kind of good view of what's happening, because there is an affordability challenge, isn't there, coming down the track, or in fact, it's here. People are facing it. Some sectors have been facing it for a longer period. Some, this is a relatively new kind of issue that they're taking on. But, I mean, what are you seeing across the market as lenders take on the challenge? What do you see? What are lenders asking of you? Could you maybe just talk a little bit more about that?
Yeah, well, I've been working in affordability for more years than I care to remember, to be honest. But and it has always been an issue, to be honest. But the issue changes as the market conditions change, and obviously we've had the likes of COVID, and obviously the cost of living crisis, and so all of these things bring an affordability challenge. But fundamentally, from a data and technology point of view, the questions are quite similar and have been quite similar throughout that time. So it's, what can you tell me about somebody's income? How can I get a better view as fast as possible and as accurately as I can of someone's income? There's then obviously, with the cost of living crisis, a bigger focus on essential expenditure, because previously models were okay most of the time, but obviously with changes in people's energy bills and the mortgage shocks, etc., essential expenditure has become another key data point that is really important to get right. And finally, the third one, and this is something that's new and emerging as a result of Consumer Duty. It's more around, well, how do I know as a lender that the affordability decision I made was the right decision? How do I know that I've been using the right data and I've made the right choice and I haven't led to any detriment to that individual who's been applying for credit? So that's more around monitoring a good affordability customer outcome, which is easy to say, but not easy to measure. And so this is where I see the trend going now, is more around how can I ensure that I am not excluding customers who should get credit.
I think one of the things that's already come up, and I know that we talked about in our pre-meeting, was that connection between access and affordability. It's been such an interesting conversation over recent years about how they can connect. And I'm just wondering, and I know that the three other panelists have all talked about access to credit at various points. I don't know if you want to just jump in and talk about that connection. Neil, do you want to kind of kick us off on that?
Well, absolutely. I mean, when we think about affordability and loans, it's pretty, at its simplest point, everyone should be able to afford to pay it back, or you shouldn't give the loan. Mm-hmm. But it's way more complicated, as Andrea says. And one of our biggest problems, for example, is we say no to a number of people who actually have been good customers, but we can't prove their affordability. And that really bothers us because they've been great customers, they paid us on time, and when it comes time to renew, we can't prove their affordability within the current framework. So it's a big challenge, and we're looking for, so the way we think about that is, can we find different data sources? Is there a different way to look at this? Can they afford this product and not that? But it's a very tricky challenge, and I'd say, we use credit data, we use open banking data, we use the income verifications, and we try to sort of compile all those together and make a good decision.
Simon, I'm going to come back to you when we talk about, well, what happens when we can. But Rob, have you got anything to add there about that connection between access and affordability?
Yeah, no, it's a really good question, because when we set up the business, we went in with this mindset of, we're going to use real customer data that we can verify. We're not going to use, statistics data or ONS data or anything that's sort of a bit more arbitrary and not connected to the user. Went to the FCA with that, and they were not happy. It was quite a difficult conversation to get through. It took about 2 years to get regulated, and it was all about affordability and how we were doing affordability. And we had to put buffers into every single category, and as a result, when we first launched, I think half our declines were because of affordability. And that was really frustrating, similar to Neil's challenge. These were good customers on the face of it, who had low risk, but actually, because of this affordability measurement that we were doing very differently, we were declining so many people, and that was a real shame. So we met to the FCA, so we want to change this and take a bit more of a measured approach. I think when you look at adding new data to an existing method, the problem is you will generally decline more people as a result. So having more data can sometimes be an absolute minefield. So you've got to change the methodology. If you're going to add new data, you've got to make allowances elsewhere in the calculation and be far more I wouldn't say lenient, but far more measured in the approach. Otherwise, more data sometimes is more problems.
Simon, sometimes you're just not going to be able to lend, even if you change and adapt for the customer. It's still going to be the right decision to turn them down. I know you've talked about the responsibility that kind of rests with lenders.
Yes, I think that, there's two things here about access, but there's also about affordability. I've been in the business 3 years, and I get the impression that when we first set up, and those first few years, the issue is more about propensity to pay rather than affordability. And I think, as you were saying about the cost of living crisis kicking in, then clearly affordability is more of an issue, of course, for us. And we're declining people on that basis. We're declining people even for loans as small as £50 on the basis of affordability. And that is really difficult. I think there's also a thing about access to credit as well, and the fact that as other, high-cost, short-term credit has been regulated out of the market, there is a vacuum, there is a gap that isn't being filled. And that, depending on where you read, that gap is possibly £2 billion worth of lending, and it really concerns us, therefore, that people are going to, unregulated lending in particular. I think that the Consumer Duty is very clear about ensuring that we do everything we can to signpost the people that we decline, the people that we can't offer services to whether it's to debt, to help, whether it's other affordable, responsible lenders. And we do our best to do that. I suppose my question, I know I'm not meant to be asking the questions here, but my question is, what more should we be doing? Because just signposting, is that really enough, given the vacuum that we're seeing, given the issues that we know our customers are experiencing, and how far should we go in order to make sure that our customers don't land on an unsuitable or unscrutable service?
And we're going to come to the questions from the audience soon. But I've just got a couple more questions just to take us into that. But this is my point at which I say to you, please remember to use Slido and to ask any questions, and we will kind of pick that up just in a couple of minutes. Interesting point there, Simon, about that kind of responsibility. I don't know if others have any kind of thoughts about that. And particularly, I think you raised Consumer Duty. What does that throw into the mix as well? I don't know if others have thoughts.
Well, yeah, this is another thing we discuss a lot. So, as Simon says, Consumer Duty, affordability are both super important things. But as a lender, and for us, for most of the people here, it's like if we say no, where are they going to go to, right? And with your eyes wide open, and I remember speaking to one of our responsible finance members, and he was saying he absolutely knows if he says no, that they're going to go and get money from the lender down at the pub or whatever. And if you know that, then you're on a consumer duty basis, that's a bad outcome for the consumer, so you shouldn't be telling him no. But then if you go back to affordability, you say, well, actually, I can't afford, he or she cannot afford to pay me back, excuse me. So this is a dilemma, and I don't know if other people have thoughts around how to do this, because I agree, signposting isn't enough. And it goes to the overall point that we've gotten rid of loads of the bad actors in this space, and the supply's been diminished, and there's a gap of $2 billion due to affordability reasons, et cetera, but we've not touched the demand, right? And everyone, I think, in this room would agree that if you remove the lender, you don't necessarily remove the need for a loan. And this is something that I think as an industry and working together, we're going to have to find a solution to, but we're not there yet, as evidenced by the huge increase in illegal money lending.
Rob, I see you nodding along. Is there anything you want to add to that?
Well, the only thing I would say, and it's kind of stealing a point that Neil raised in the pre-call, is we've seen this massive rise in unregulated lending in the form of buy now, pay later, which doesn't have the same kind of regulatory requirements. And they obviously have a functioning commercial business without the need for the scrutiny that we have around affordability. So they've almost proven that there's actually a market out there that's making payments and can pay. So clearly something's wrong. I mean, obviously they might fall into regulation soon, and that might change who they accept, but there obviously is a big commercial opportunity that's been wasted that we're not obviously being able to tackle.
Yeah, and Neil, on that BNPL, do you have any more to add to that?
Well, yeah, I mean, again, it's probably done a good thing overall in the sense it's filled the gap for a lot of people who've needed access to credit, but we've all seen this happen a million times. When you have an unregulated lending space, it can go bad very quickly. And to Rob's point about it being profitable, like that can be also quite dangerous because, if we go back to the bad old days of payday loans, those were all very profitable, but it meant outcomes were really bad for 20, 30, 40% of the borrowers. So sometimes, especially with lending, it can be profitable, but it cannot be good for society. So we need to figure out what the right balance is there. I think with buy now, pay later, of course we need to add regulation in. There needs to be more of a focus on affordability. But going back to what we said, we all talk about affordability, but what is that? Because they clearly can afford to pay this stuff back or they wouldn't be growing like crazy.
I'm looking at the questions. Maybe if we put the Slido questions up, I'm going to merge together a couple of questions here to you, Andrea. We're going to start with, it's kind of open banking, data sources. I'm going to kind of start with the, what alternative data sources over and above open banking can be used by lenders to make a more personalized affordability decision. What are you being asked for, and what are you providing in terms of new types of data that you think would be helpful in those affordability decisions?
So if we look at income data, so there's two sides to the equation for an actual affordability calculation, income and expenditure. Okay, so if we take income, obviously the most commonly used form of income through a lending process is Cato data, but obviously there's a good 20% where there's still non-consented data. So that's where you look at alternatives such as open banking to fill that gap. But we are also looking at other data sources to fill that gap as well, so payroll information and also HMRC. But there isn't a single solution that will enable that view of someone's income. So it is about using multiple sources and bringing them through technology through one solution. If we look at the expenditure element, now that's even more complicated. Okay, so to get a really good source of someone's disposable income where essential expenditure is really difficult. So we have to fill the gaps with factual information where we know it. So try and move away from the reliance on models. We will still need them. They're still valuable. But where we do have alternative data, so we know how much someone's council tax is, or we know how much someone's childcare is through open banking, then you replace those elements that are in the model with factual information, and that will give you a better view of someone's individual affordability.
That's interesting. And staying on data, I think one of the questions here, which I think is a topic that's being discussed, is whether open banking actually, more data is actually helping us to increase inclusion, or is it more about exclusion? I think this is a conversation. I'm involved in the working group that's setting up the new credit reference governance body, and a big part of their discussion is about inclusion, and my conversation with them is data and inclusion are not always, there's sometimes a question there, but I just wonder, from the lenders, do they think open banking is going to help, or is more information better for us? Simon?
Yeah, we use it. It does help, absolutely. We don't use it exclusively. We do use CRA data as well. But I think, your point earlier about more data doesn't necessarily make better decisions. It makes different decisions, and we are very mindful of the fact that we could be, as a result, excluding people who could afford to pay back. I think the other point, not on affordability, but perhaps more on propensity to pay, is that we're exploring psychometric questions as well to help with our overall assessments on people. And that's, I think the jury's out at the minute, but it's an interesting way to go.
One of the questions, moving away from data, one of the questions here, the most popular question is, do big banks have a fiduciary responsibility to lend more to at-risk customers to ensure that they don't go to illegal lenders? So this is the role of banks. Does anybody want to jump into that controversy?
Well, can I just say, given that the charity that owns Fair For You issued a white paper, grandly titled, on precisely this point, that banks do have a responsibility to lend, and moreover that if they did so, they would find that many of the customers that they're lending to turn into very loyal, great paying customers. And I think that all the things that we've talked about the gap and filling that gap, banks could do a lot more to do so.
I'll be a bit more controversial than Simon. I think banks should absolutely step into this gap a little bit, but I think they won't, because a lot of what we're talking about is often short-term lending and small size, and the APRs go up too much that then the banks would get dragged all over the press for lending at high APRs. that's just a fact of life. But also, my biggest bugbear is bank overdraft. It's essentially a secured form of lending at an extremely high rate, and I do think banks should be getting those costs of lending down, and they could pass that on to people who need more help.
Anybody else want to take a kick at the banks? I'm happy to jump in as well, but
Just like a middle ground view. I mean, we are backed by Nationwide, so I have to be quite careful what I say these things. But we have done some work with bank referrals. It is painful, and there's a lot of stakeholders who need to get aligned for it to happen. But there is a lot more appetite for it than it used to be. So there was recently, I think it's Lloyds are doing a trial now with credit union referrals, and it is getting there. I understand when it was predominantly branch-led, bank managers were a lot more active in referring customers to other alternative forms of lending in their local area as well. So I think it will move that direction, but it's moving very slowly. But as I think Neil kind of said, there's a gap in the middle between the high APR short-term stuff and what banks do, and that sort of, that hasn't quite been sorted out yet. You shouldn't really go from a bank to a credit union. I think there's a couple of parts of the commercial market in the middle that could serve those customers before they need to go to a not-for-profit kind of solution.
there is a discussion, a political discussion going on. I mean, there's not much political discussion happening because people, Ming Va's strategies and all of that. But I know there's been discussion about a potential Labour government looking at a Fair Banking Act, which would look at a connection between banks and communities that are kind of excluded. So that will be interesting to keep an eye on to see whether that kind of emerges from the political campaign and becomes something that we'll look at down the track if there is a change in government.
I don't think, Jason, any of the, and correct me if I'm wrong, I'm sure someone will, any of the manifestos of the major parties have included a Fair Banking Act.
No, I don't think they have, but I think people on the edges surrounding, I think we both know people that are on the edges of that are well connected, that are kind of talking to people like Labour about this. So, yes. Interesting. I'm going to go back to the questions just to make sure that we're kind of answering from the. I mean, this is probably, we've already started to answer this, which is one of the FCA's main priorities is financial inclusion, though there was a discussion about how big an objective that should be for it. But the approach on affordability has clearly had the opposite effect. Lenders cannot be forced to lend, but how does the industry come together to solve this issue? There's probably a question there about the role of the FCA and the role of industry. Does anybody want to jump in on that one?
I think, sorry.
No, you
well, there's something about referrals, isn't there, and the fact that we are restricted in what referrals that we can make to other organisations, and it does seem it does seem a problem for us that we can't ensure that somebody who we may not be able to lend to, but we know that Neil can, that we can't make that referral necessarily directly. And I think there's more that can be done to ensure the credit broking is a bit more sensible. But I think it's trying to make sure that we're more networked, I think, and being able to ensure that our customers that we can't deal with and we can't serve, but somebody within the responsible lending, affordable lending sector can. And I think we're struggling as a sector to be able to do that.
Does anybody else want to jump in? Andrea?
Yeah, I was just going to say that I think one of the difficulties and one of the questions that I find difficult to answer is what is a good affordability outcome and how do you measure that? Because I'm pretty sure that we will see a lot of consumers who are refused credit and then go and get credit elsewhere and actually perform well. And by perform well, I don't mean they're paying that lender because that's a credit risk measure. What I'm saying is that they don't look like their overall financial situation has got any worse. So I think as an industry, as lenders, we could get together and help define what a good affordability outcome looks like. If we have, I'm not saying it's a single measure, it may be a number of different measures that we can track and monitor, and then we're all ensuring that actually we are making good decisions, good affordability decisions, that means we are not excluding people who should have access to that credit. So I think we can do a little bit more as a group of people to try and define truly what a good affordability outcome is.
Thank you very much. I'm just aware we're coming towards the end of the session, and what I kind of promised you all was a kind of last minute kind of what can we give to the audience in terms of a takeaway? What can we give to them in terms of an area that they should be looking at, a tool that they might want to use, or something that we should all be working on together? Is there something there, a piece of wisdom, I guess, I'm looking for from the panel as we come to a close? And Neil, I'm going to come to you first off.
Piece of wisdom.
Piece of wisdom that they can take away.
Well, look, I think just from this panel, it's clear that we don't have a clear definition of what affordability is. And what Andrea was going to say is, I think taking that further is if we just had some clarity and transparency across the whole industry, that would help kickstart a lot of stuff, because investors are on the sidelines, investors have been burned, people don't want to get involved, now there's consumer duty, we don't know how that's going to react. So all of that means is there's a lot of sort of frozen behavior, and if we just had some clarity, the industry could move forward.
Thanks. Rob, you want to pick that one up?
Yeah, I mean, I think just to reiterate what I said before about more data can sometimes be difficult if you don't change the method. So open banking is no longer a new thing. You know, I think most lenders are looking at it for some form, you know, in the process, whether it be income verification or an affordability assessment. But I think the key thing there is what's the methodology. And I like this concept of propensity to pay, which Simon's been talking about, because that's really what you want to get to is can they prove that they can repay this product, not whether their I&E perfectly matches at this snapshot in time that you're doing the assessment. So that's my only thought. If you're adding open banking, which I'm sure you already are looking into, make sure you change how you do the approach in a compliant manner, which is the hard thing to get right.
Simon.
0% microloans have a very low default rate. Because people realize, as indeed Mohammed Yunus realized, you know, if you give small amounts of money to people at a very reasonable, if not 0% rate, they are going to pay back because they won't want to lose that facility. And I think that, you know, going back to what the banks can do, if this is a loss leader, because you will encourage people to repay, you'll ultimately perhaps encourage people to be savers when their credit files are repaired, and you've got the basis then of a great paying customer base. And I think that, you know, there's more that can be done on that 0% micro lending, beyond what we do, beyond what the no interest loan scheme does, anything like that. But as a society, we should look more seriously at that.
Thank you, Simon. Andrea, you want to end us off with a piece of wisdom?
Well, I think it's very clear from this discussion that there isn't a one-size-fits-all solution. And I think that obviously I work for a data and technology company. I think it can be used for good. And I think, again, what we need to do is understand what data should be used when to ensure that we've got a great customer outcome.
Thank you. And I think you make a good point there, which is, I think that we're quite clear that in terms of tackling this, there is no silver bullet, there's no single button that we can press. And I think that many of the people on this panel have got different ideas of how they can be part of the solution, which I think is really good. So with that, I'm going to kind of draw this to an end. I'm going to ask the audience if they can thank the panelists in the traditional way.